Before we begin the program, here's a few notes. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA, SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. TechGrow Financial and Cambridge Investment Research, Inc. are not affiliated companies. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.
What will you do when your money works for you? Welcome to the TechGrow Financial Podcast with your hosts, Victor and Kim Gaxiola. From the home office in California, here is Victor and Kim.
So, Kim, we have another exciting podcast for today.
All right.
Yeah. So, obviously, if you saw the notes, you see that coming back to the program is Gerry Mihalick from Berkshire.
Oh, Gerry.
Gerry's back.
And the Rising Dividend portfolio.
Exactly. So Gerry joined us, actually, it was crazy. It was 2.5 years ago. Season 5, Episode 8. If you haven't listened to it, I highly encourage it because based on the interview we had with Gerry in this podcast, it complements it really well. Mm-hmm. And going back to listening to Episode 8, Season 5, one thing that was fascinating to me were some of the headwinds that we discussed in that podcast, which actually came true, was this concern about inflation, the concern about, interest rates, the concern about politics and political risk. And then you listen to it and you go, this was recorded 2.5 years ago. And now with the benefit of hindsight, you realize, wow, we were onto something there.
I know. I just hope that Gerry doesn't foreshadow what happened in 2022 and 2024 because the market went down 15, 20% in 2022.
So enjoy this interview with Gerry. We talk about, again, interest rates, recession. We talk about the Magnificent Seven. There's a lot of things to unpack there. So please enjoy this interview with Gerry from Berkshire. So we're thrilled to have Gerry back on the program. It's been 2 years, as we mentioned in the introduction. So Gerry, welcome to the show.
Yes, welcome, Gerry.
Thank you. It is great to be back with you, too.
So much has happened in the last 2.5 years, and so we really wanted to get your take in light of all the changes that have taken place in 2022, 23, and what we've experienced so far this year. And that's exactly where I want to start is, what are your thoughts on where we are now in the market?
Well, since that time, it seems we've had inflation scares, recession scares, back to inflation scares. Fed needs to cut rate. Fed needs to raise rates more. Fed needs to cut rates more. It's been very, very erratic. And a lot of this was punctuated this week. But one thing remains true is that our approach of trying to find high quality dividend paying stocks, companies that can grow the dividend and who have business models that can kind of plow through all the noise and all the volatility remains really a foundational principle for us. So while there's a lot of noise and gyrations going around, we're holding steady and trying to plow through.
It's funny, though, how things have changed, but things may be a little the same as when we talked to you last time as well, because we felt like stocks were overvalued and pretty frothy back then. We still feel like that today. But the difference is that was before the big change in interest rates happened. And now we're at the top of that interest rate cycle. So what are your thoughts about interest rates and maybe how they pertain to your portfolio, rising dividends?
Sure. Well, it's been very interesting throughout the last year and a half or so. Certain sectors of the market got very, very expensive. And we've all heard about the Magnificent Seven throughout the market, the S7EP 500, and also in the growth index, where you had a very narrow group of stocks like NVIDIA and Microsoft and the likes and Apple take up really a disproportionate amount of the index. And these companies had become such large weights within the index that just kind of small movements from those stocks could have a disproportionate effect on the overall index. So what phenomenon you saw happening was these stocks were going up, and it made it look like the general averages were going up a great deal, but the average stock and many dividend stocks in that camp as well seemed to feel left behind. And I think investors definitely had a lot of FOMO where they're seeing the indexes going up quite a bit and saying, hey, why aren't I up as much? And it's because the average stock wasn't doing as well. But that's kind of all changed really in the last week or so, because what you have seen is as the Fed has come full circle now to the point where instead of having to raise rates aggressively to battle inflation in a very hot economy, now there are some signs that the economy might be cooling too slowly. And as a result, you're seeing some of those really high valuation tech stocks that had wild growth expectations built in start to come back to earth. And it has been a very, very large rotation that appears to be real, of great magnitude, and maybe persisting for some time.
Yeah, I'm glad you brought up the Mag 7. It was actually one of the questions I wanted to address. And it had to do with the fact that, we've maintained the same discipline that you have in looking for, strong companies with good valuations that are paying a dividend and hopefully increasing that dividend over time. That's been the strategy. And I think the last time when we had this conversation 2 years ago, we referenced the tortoise and the hare, and the tortoise gets through the finish line, not as sexy, not as flashy, but is consistent. And so with the performance that we saw in the Mag 7 and its influence on the overall performance of the S&P 500, it was challenging at the beginning of this year, looking back at 2023, to defend, that strategy in light of the fact that people are saying, well, why am I not getting S&P level returns? Because that's the benchmark that most people compare to. And he said, well, you had to make this case for, the Mag 7 was really pushing that S&P 500. If you look at the 493 remaining stocks, they didn't perform as well. So how do you defend, or how would you defend this strategy in light of what we saw with the Mag 7?
There's a few ways I would think about that. Number one, it really is apples and oranges, that every portfolio has a different job to do. And for some portfolios, it is rapid appreciation and to be participating in sort of like the latest and greatest tech stocks, companies that can compound earnings and have rapid appreciation. And that's fine for the growth managers. They certainly have a place in a diversified portfolio, and they have done their job over the past number of years very well. But for a portfolio like ours, our first comment would be our job is to generate dividend income, to grow dividend income, and to provide safety on the downside when markets get very difficult. And as you look over the last number of years, that's exactly what we've been doing. We've been sticking with our job, buying companies that have been able to do just that. Most of the companies in the top tier of the Mag 7 don't even pay a dividend, or if they do, it's very small. So that's my first comment about defending the strategy. Next up, I put it kind of back from the lens of a relationship between a financial advisor and their client. And it's not necessarily a financial advisor's job to, quote, make as much money in the stock market as humanly possible. That's not really what the job of a modern day financial advisor is today. It's really more about finding the right diversified set of strategies that have goals and risk tolerances that align with the actual client's goal. And if you can accomplish those income needs and growth needs with a very conservative income growth sort of approach like ours, that's fine. And investors need to kind of check their FOMO at the door a little bit and realize that it's not their job to be chasing the market ever higher, because that might not be in alignment with their true goals.
It's funny. The older I get and the more years I have in this business, I think I get a little bit wiser with time. And I always like to compare things to a physical trainer. You know, a physical trainer will help you get stronger. They're going to do they're going to push you to your limits so that you are growing and getting healthier and getting stronger. But they're never going to put you, you know, into some weight program or weight training program that's going to injure you. Right? It's a fine line between injury and growing stronger and having a little discomfort in order to grow. And I think that is what we do here in our business too, is just, you know, I never want somebody to be so uncomfortable with volatility that they're going to sell out at the wrong time. That's the case of injury. But you do need to be in the market enough, and it's going to feel a little uncomfortable from time to time, but that is the only way to get those accounts growing for you.
Right. And I would imagine that your clients are probably some version of, you know, 40, 50, 60, 70. And if you were their personal trainer, you wouldn't try to say like, well, we need to make you look like Arnold Schwarzenegger in the Terminator from back in the day either. You know, that's just an unrealistic expectation. And maybe the analogy kind of carries over that it's not necessarily appropriate for you to be swinging for the fences investment wise to try to get these like massive gains, because again, there is a risk of injury. And instead of injuring your body, you're injuring your long-term spending power by trying to lift too heavy, I guess.
I love that analogy of Arnold Schwarzenegger. Most of us won't be able to get there.
Well, and I want to go back to say how much I appreciate you saying about the discipline, because I think that that's a very key piece to that in saying that, look, we maintain a specific discipline to manage money in a specific way. That is the objective. And we're not going to derail ourselves, you know, to, even though we are a dividend paying portfolio, that we're not going to go after a flashy stock and because it doesn't pay a dividend. So we're going to stay in our lane. And I think that one thing I've really appreciated over the last couple of years, and in going back to like how I was defending the fact that we maintain people in these more tortoise level stocks, the non-drama, non-sexy, but gets you across the finish line stocks, was exactly that, to saying we're going to maintain this discipline because our time horizon for this is not just a year, it's not just 2 years. And with it came this confidence, I would say, of my experience having seen the cyclical nature of the market, to know that, yeah, the Mag 7 was hot in 2023, but that's not going to continue. And we started seeing signs of that this year. So it was almost like a pat on the back for myself to think, okay, I've had the experience to know that these things are cyclical, but by maintaining that discipline is really how I'm adding value to my clients.
I think that's right. I think you're on point with that. I was at a retirement dinner for a financial advisor last night, and the comment was that Warren Buffett was only worth 1/20th of what he ended up being worth when he was 52 years old. And that really speaks to the power of long-term compounding in investments, whether it be the growth of principal or the growth of income. So from our case, we just celebrated our 15th year anniversary for running this strategy for clients. So we're really excited about that. And then if we look at the history of the annual income from the portfolio and the power of compounding, when we started the portfolio, if you gave us $1 million, it would be worth about, the annual income would be about $37,000 annually. That same portfolio today is generating over $130,000 in annual dividend income. And excuse me, we would ask kind of clients and planners to reflect on how that impacts a client's financial life, whether they're saving for retirement, saving for future liabilities, saving for loss of income. That type of annual income really allows for a lot of planning flexibility to do a lot of other things. And we remind clients that type of annual income generation and growth over the last 15 years came at a time when seemingly every year there was some macro reason not to invest, whether it was an election or a recession or coming out of the financial crisis or the United States losing its AAA status, or whether it was a pandemic. So I can't think of really a better advertisement for staying in the market through thick and thin, more so than that concept. And oh, by the way, the market value has grown very nicely from $1 million to over $5 million. And oh, by the way, that portfolio cumulatively, if you added up all the dividends collected, it's over $1.3 million in cumulative dividends paid, which now exceeds the initial investment. So it's not perfect. Nothing is. There's risk with everything. It may not be as sexy as the Mag 7 or growth, but there's a lot of different ways to win by investing in this manner.
And it's funny because I've started to change the dialogue in some of our reviews. Is now every year I'm showing them the income from that rising dividend portfolio, and just started this about 2 years ago. So I have 2 now to show them. And it's funny because it was like back then in 22, and now in 24, we're comparing the dividend, and yes, the dividend has increased. And just by focusing on something different than the growth of the portfolio, but by saying, sit and let this bake and let those dividends increase over time, and that's going to be your retirement income. All of a sudden, clients can see them retiring and understanding how they're going to derive an income from this portfolio. Because I think it's still very confusing for clients to understand, okay, I'm going to retire. Now what? They just see themselves clipping from the portfolio, and every year it getting smaller and smaller. And so this exercise of showing them the actual dividends, I say it's like drops of rain in a bucket.
We've used grains of sand piling up, but I like drops of rain in the bucket better, because grains of sand, I feel like one ocean wave wipes it out, and that's not true. So I like drops of rain in the bucket better, actually, Kim.
Yeah, it's been helpful. And it's funny because the report comes out and it does look like just little drops of rain, because when you look at each individual stock, it may not be that much money, but when you combine them all and tally it all up at the end, they're like, wow, I never realized it was this much. So it's funny to see it. We show it to them on a monthly basis, and we show it on an individual security basis, and it really does a good job of illustrating that. So I want to change gears and talk about, it's the beginning of August, and we just had a big earnings season for half of the year has gone by, which has happened very fast. Are you noticing any changes in the economy by what's come out of the second quarter earnings season?
It's funny, going back to your rain analogy, I'm in Pennsylvania, and we were actually getting remnants of that hurricane. I think it was Hurricane Deb, and we've had like 2.5 inches in an hour. So wow. I wish our dividends would be filling up the bucket as fast today, because it's a deluge out here. But what we're seeing, shifting to corporate earnings, generally, earnings have been good. Company profits have been very, very resilient. But if you're looking through some of the discussions and what's happening and link it to monetary policy, you see the market getting concerned that maybe the economy is too soft. And that's why you're seeing, calls for increased rate cuts. And rate cuts in general are viewed as good for stocks to a point, because if there's pressure to cut rates too aggressively, that might mean that the economy is weak. And that's, I think, a little bit why you've seen that volatility here this past week. Like, hey, the Fed needs to cut rates. But what we're also seeing in a lot of corporate announcements, whether it's particularly in the consumer space, companies like Target and Walmart and Starbucks, some of which of those are in our portfolio, some are not, are kind of saying that the consumer feels very tapped out from higher prices, whereby they are feeling the pinch of past inflation, and they are trying to, substitute with cheaper goods. So I think what companies are saying is consumers have reached their limit for price increases. So we think that's a very noticeable change that is kind of flowing through a lot of company announcements, mainly in consumer, but you start to see that kind of go through, some other sectors as well. So that's been, I guess, if you're looking for something to worry about, I would say that would be one of them. Consumer feeling more strained due to past inflationary pressures.
Yeah.
Which seem to be abating. And the one thing that's important to remember about inflation is, inflation's getting better. Well, inflation refers to the rate of change of prices. It doesn't mean that prices are going down. It means that the rate of increase is starting to slow. So where prices were increasing at, 8, 9, 10% a year annualized, now the rate is starting to slow, but it doesn't mean that prices are going down.
Exactly. I know it's hard for a lot of people to interpret that correctly.
Right. Just to say, inflation's under control, that doesn't mean that prices are going down, or that your gas price is going to go lower, or that your box of cereal is going to cost less. It means that it's just not going up in price as fast as it was.
Yeah, and then the other trend that I started seeing and actually experienced it for the first time about a couple months ago, so it wasn't anything new, was the whole concept of shrinkflation, and what became very evident from a physical standpoint was I was buying the 1.25 liter sparkling waters at Trader Joe's, and I went in there the other day. I used to buy it by the case, and the other day I noticed that the cases are now 1 liters. Price is still the same. But now I'm getting, 20-25% less water for the same price I was paying before. And it was just like this little subtle, okay, I'm not raising the price of the water. You're just going to get less water.
Right. Yeah. I'm not sure shrinkflation is an economic term, because to me I'm still paying the same and getting less. So that's still bad. So again, that's why we come back to, I'm trying to think of what the opposite of shrinkflation is in dividend standpoint. Like, we're hoping that our portfolio has the opposite of shrinkflation, where you're getting more dividends out every year than you were the year before. I mean, that's the whole concept behind this portfolio, is to try to manufacture more dividends out of this portfolio for a given dollar that's put in, so that you can get more purchasing power to battle things like shrinkflation or inflation or, disinflation. We still need to put more dollars in your client pockets through dividends.
Yes, that's true. So with that idea in mind, are you seeing a change in dividend growth right now?
I think out of, the pandemic, I don't want to say change everything, but we have seen companies be a little bit more cautious, and some of the larger double-digit increases that we saw kind of pre-pandemic are getting a little bit more scarce, for lack of a better term, because I think coming out of the pandemic, companies were nervous, and now faced with some potential economic softness, they have been slightly stingier with increases across our universe, but we still have had a number of pleasant surprises in the portfolio. We've had, one of our large retailers grow close to double digits for the first time. They've historically been a lot slower growing. because they were reinvesting in their online business. So we were pleasantly surprised there. And we were also pleasantly surprised by the banks in our portfolio because we've owned banks for a long time and still kind of like, it's, a decade and a half later or more. And I think a lot of these bank companies still get painted as an '08 type of phenomenon and people are scared. And if you even go last year around this time, there was threats of higher interest rates and how that was going to affect their balance sheets. But also you had commercial real estate woes, that there was going to be 2008 all over again. And some of the financials, which are not widely loved and held by dividend managers in entirety, we saw some pleasant surprises out of that sector. Surprisingly, in our tech sector, which we own a couple very, very large mega cap names that generate just billions and billions and billions of excess free cash flow that have been a little more stingy than we think they should be. And I think that's because dividends in tech land aren't viewed as cool. You guys are out on the West Coast. It's all,
flashy
type of money. If you have to pay a dividend, that means you're not really a growth company. But from a corporate finance perspective, they certainly should be.
Yeah.
But in general, pretty good. If we're still averaging a lot of companies 8 to 10, 8, 9, 10% type of dividend growth, we're pretty happy with that.
Well, I will tell you, here in the Bay Area, in the past couple of weeks, I've had more conversations with people about layoffs and potential layoffs. And so we are feeling worried. A lot of people are feeling worried out here in the Bay Area. So what's your opinion? And I know I'm not going to hold you to this, but do you think we do some sort of soft landing, or are we in for a recession?
I think it's not so much the recession itself, because the business cycle does ebb and flow, and that should be normal. And it's also healthy because a recession is, symptomatic that, people were getting kind of carried away relative to the growth opportunities. So in some ways it, trims back what needs to be. And I don't think people should be necessarily worried about that in itself, because economy ebbs and flows, earnings as a result ebb and flows, and that's just natural. That's just the way life works. But the bigger question is, can we avoid some sort of associated bubble or calamity as a result of someone getting too extended? And that's where we saw, maybe commercial loan or real estate, or where there's like a large amount of leverage attached to some sector that is undergoing a downturn. That's when things get more, I'll say, cataclysmic. And the financial system, and implicitly, clients are always worried, like, oh boy, is this recession going to be 2008 all over again? I think that's still in their minds. And we think that the financial system is wildly different than it was then, and banks are far stronger. So if we do get something like that, the system is much more equipped to handle it, over time. So I am, I'm not an economist, I'm not a macro forecaster, but gun to my head, I would say soft-ish type of landing. And yeah, you'll get some scare from some maybe remote corner of the financial landscape that gets hit really hard. But the broad contagion that we saw in '08, or even so much with the pandemic, we don't see that on the horizon.
It's so good to have weathered 2008, because if that's your benchmark, everything else is easier.
That's true. Well, as we all know, as financial professionals and having had experience in multiple markets, that the markets themselves do not like uncertainty. And one of the biggest uncertainties right now, and I just want to bring it up just because I think it's important, and it's something that our clients ask about, is when it comes to the portfolio composition, what impact does the upcoming elections have to how you approach the market?
I know this is going to sound like a cop-out, but I just don't think that anyone can appropriately like handicap, because you get all this chatter about a new political regime and everybody runs one way thinking, oh, it's going to be this or that. And then you realize that we're still living in a democracy and that there are checks and balances in government, and neither party gets what they want, and it just you never know where it all ends up. So to try to really invest around that construct, we really are pretty disciplined about not commenting on that, with the exception of companies like ours in our portfolio tend to have very good financial flexibility, and they will adapt as best they can. And we trust the managers of our companies, the CEOs of our companies, to navigate that political realities, regulations, opportunities, constraints as best as they can, and leave them to it, as opposed to us trying to overreact. And I know it's such investors hate that answer, because they want to be like a linear type of thinking where, okay, party X gets involved and they win and they bring these rules and that affects, and it's just a more amorphous type of thing that I don't think that does not lend itself well towards linear thinking and mechanical thinking, and it's all unintended consequences and adaptive systems that make it very difficult to handicap.
Yeah. Well, I'm going to get a little philosophical and maybe a little religious, but I think that we have too much hero and godlike reporting in the media of our politicians when they are not all that. And we should not give them that much credit, because like you are saying, there are three branches of government, and even government, we're talking about stocks. We're talking about what corporations are doing. And I guarantee you that most of those CEOs and managers, and especially the sales people, are just thinking, how do I drive the bottom line? And no matter who's in office, they still want to win and they still want to grow. And that's just a difference in where we shift our frame of reference. And I will say this too, because I just listened to a podcast where Megyn Kelly interviewed Neil Gorsuch. And I have to tell you, those Supreme Court justices are very friendly and respectful of each other. And the relationship that they have and that whole balance of power is very impressive. And, after hearing that conversation, it did give me more confidence in our system as well.
And I was going to say, Gerry, I'm actually happy to hear and encouraged to hear your answer from this, because it's how I feel too. I think too much weight and emphasis is placed on the executive branch and on upcoming elections to think that of the sway that it may have on the economy. When it comes down to it, it's really, again, going back to valuations, quality products, quality services, and that's what I've been telling our clients, is that when you look at a portfolio composed of mostly dividend-paying stocks, you're not looking at startups. You're looking at established corporations that have been around, many of which are holding a lot of cash that they can either reinvest in the company or pay back in a dividend. So it goes back to quality. And I don't think quality really cares who's in the White House or who's in Congress.
So this has been such a great conversation. I have one last question, because it's the buzz, around the stock market and everything else, and that has to do with AI. And my question to you is, how will you and your portfolio management be using AI to help you with what you do?
It's funny, we likens back to the internet when it was first proliferating in 99 and 2000. And it was at first derived by, well, there's internet companies and there's non-internet companies. And of course, the pure tech plays got all the love. But then I think if American companies do one thing great, it's adapt and lead in technology. And in the case of the internet, it ended up permeating in a positive way through every part of American business. And if you think about how any company does anything now, like, it is just quantumly different than what it was back in the early 2000s. And the internet is just everywhere and permeates through every facet of life, as we saw with that. Unfortunately, as we saw with the outage that we had a couple Fridays ago from the patch from the name of the tech company escapes me at the moment.
CrowdStrike, yeah.
CrowdStrike, right? So that's the internet is everything, and I think going forward, there won't be AI companies and non-AI companies. I'm sure it will be incorporated into all things. I find AI right now in my daily life just getting started. It is, I think, a superior research tool to traditional Google search. So if we're looking up, factoids on companies, or give us different perspectives on how different things work, we're starting to use it there. I don't know if you read my Casual Friday this week, but we were talking about global carry trades, and I related that to how people are trying to buy Taylor Swift tickets.
Yes, I love that. I was like,
I may or may not have queried ChatGPT to relate some song lyrics from Taylor Swift to the trade, and that's where a trade gone bad. I was able to use a blank space, baby, I'll write your name. So I use it from a creative standpoint there. So we had a little fun with that this morning for sure.
Oh, that's funny. I did appreciate that. Taylor Swift's arbitrage story just went a little ugly with the terror.
Yeah.
Or the
who says our industry can't be fun, right?
Well, that's true. And I think that's one of the things we like about our firm is it's not the big institutional robotic type of thing. We're a national firm now with national protocols and national type procedure in place, but we're also still small enough to be personal, flexible, and have a little fun from time to time to make our point.
Well, on behalf of our team here at TechGirl Financial and our clients that we represent, I just want to say thank you to you and your entire team for all that you do in maintaining that discipline and providing value to these portfolios, and being extremely selective, like I said, when it comes to portfolio construction, to find that quality that people need in their portfolios to have those consistent results. And so, and I want to personally thank you again for coming back to the podcast. We love having you on. Hopefully we'll have you back again. Maybe we won't need to wait 2.5 years before that, but it's always a pleasure.
Yes, just hit my calendar link. I'm always happy to talk to two of my faves.
Oh, sounds good. So with that, thank you for joining us, and we hope you enjoy the rest of your summer and the rest of the year.
Thank you, you as well, and thanks to allowing me to work with you and your clients.
Thank you very much, Gerry.
It's always a pleasure to have Gerry on the show. I hope we get him back and maybe on a regular clip, right? Just bring him back because it's always a great conversation.
He is very great, and we are so thankful and appreciative for him to come to our podcast and share his world with us.
Absolutely. And I hope that by listening to his approach, it makes our approach make more sense from the standpoint of maintaining that discipline to ensure that, one of our responsibilities is obviously wanting to select quality products. And with that comes with working with quality organizations to build these portfolios so that they manage according to their objective, which is really to get that steady and constant return and lower the amount of risk.
Right. And what we really hope that you gain from this conversation today is this whole idea of eliminating the noise and the distractions and just focusing on what your portfolio is doing for you. And it's not always about returns.
That's correct. So if you're interested in learning more about this strategy and think that it's something that could suit your portfolio, feel free to reach out to our team. There's always a contact us or schedule a meeting on the show notes of the podcast, but you can also find us on the website at techgrowfinancial.com or reach out directly to me by email at victor@techgrowfinancial.com. We always encourage you, as we do it with each podcast, to just follow us on our social media networks, as well as just continue to listen to the podcast.
Yeah, and I would just say, as we go through this crazy election cycle, stay focused, stay disciplined when it comes to your finances, and remember what you will do when your money works for you.
That's a good way to end it. So we hope you enjoy the rest of your summer, and we'll see you at the next time on the next show.
Bye.
If you have questions, comments, or suggestions for future shows, please send an email to victor@techgrowfinancial.com or join the conversation on Twitter using the hashtag AskTGF. We also encourage you to follow us on the Tech Girl Financial page on Facebook and connect with us on LinkedIn.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA, SIPC. Investment advisory services offered through Cambridge Investment Research Advisors, a registered investment advisor. TechGirl Financial and Cambridge Investment Research, Inc. are not affiliated companies.